Imagine the government asked you for a loan. Would you hand over 100 rupees right now if they promised to pay you guaranteed interest every 6 months? You don't need a finance degree to understand the setup. That simple theoretical exchange is exactly what a government bond is. To understand why they are asking for your money in the first place, look at the sheer scale of national infrastructure. Building thousands of kilometers of concrete highways requires massive amounts of capital up front. Add in the costs of maintaining a nationwide railway network, funding the military, and running public welfare programs, and the state's daily expenses multiply rapidly. The government tries to cover these costs by collecting GST, corporate taxes, and income duties. But what comes in is rarely enough to cover what needs to go out. Because of this gap, every expanding nation operates on a deficit. The government requires far more capital to build the country today than it can immediately extract from taxpayers. If the government controls the currency, why bother borrowing at all? Why not just print the exact amount of cash they are missing? This diagram illustrates why that doesn't work. Imagine a closed village economy that produces exactly 100 apples and has a total money supply of exactly 100 rupees. Naturally, one apple costs 1 rupee. If the authority simply prints another 100 rupees without growing new apples, the money supply doubles to 200 rupees. Since the total apples haven't changed, the price of a single apple is forced up to 2 rupees. Printing extra currency doesn't magically generate wealth or build new roads. It simply waters down the purchasing power of the money already sitting in your pocket. Because inflating the currency is an economic trap, the state has only one viable path to fund national growth: legally borrowing the shortfall from the public and financial institutions. Instead of taking one massive loan from a single bank, the government writes a giant IOU and slices it into millions of tiny, manageable pieces for anyone to buy. This timeline tracks the cash flow of a single investor. At year 0, you purchase a piece of this debt by lending a principal amount, often called the face value. Let's say 100,000 rupees. In return, the government agrees to pay you a fixed interest rate, known as the coupon. If the coupon is 7%, the government pays out 3,500 rupees every 6 months. This continues until a predetermined future date called maturity. On that day, the government returns your original 100,000 rupees in full. This precise schedule is why everyone from individual retirees seeking predictable income to multi-billion-dollar pension funds relies heavily on these payouts to survive. A government bond takes stagnant savings from private bank accounts and turns them into active national infrastructure, while returning a reliable income stream to the lender. You might wonder why massive institutions are willing to lock up billions in these paper promises instead of chasing higher returns in the stock market or real estate. The borrower here has a unique financial advantage. To ensure they never miss an interest payment, the state can legally raise taxes on its citizens or simply issue more debt to cover the old debt. And if all else fails, they have the ultimate backstop of their central bank, providing a sovereign guarantee to the promise. Because of this, the probability of the government outright defaulting on your money is practically zero. But in finance, being safe from default does not mean you are immune to losing money. Many retail investors buy a bond assuming it acts exactly like a locked fixed deposit at their local bank branch, where the value stays perfectly flat until the term ends. The reality is different. Bonds are highly liquid assets that are actively traded back and forth millions of times a day on the open market. Because you can sell your piece of government debt to another investor long before it reaches maturity, its daily price is completely at the mercy of market forces and shifting interest rates. Let's test what you'd do. If you had 1 lakh rupees to park right now, would you put it in option A, a savings account, option B, a fixed deposit, or option C, a government bond? Drop your choice in the comments. And while you're there, tell us, if the government offered you a 30-year bond today, would you be willing to lock up your money for 3 decades? Justify your answer. That brings us to the core mystery for our next module. If the government's promise to repay your 100 rupees at maturity is absolute, why might that exact same bond trade for 85 rupees or 115 rupees tomorrow morning?